This is Professor Stephen Litch in the Principles of Economics. This lecture on macroeconomics covers unemployment and an introduction to financial markets. I recorded this lecture in class on November 12th. Okay, let me get started talking about unemployment. And mainly, I want to talk about how unemployment is calculated, how to interpret the unemployment statistics, and then a little bit about why unemployment exists, or causes of unemployment. So, first, let me talk about how this is calculated. Every month, the Bureau of Labor Statistics is responsible for going out and surveying a bunch of households about their labor market behavior, including questions about whether they are working. Okay. And let's see, I think they conduct this survey of about 60,000 households a month and try to determine, among other things, the number of people who are employed, unemployed, and the unemployment rate. Okay, so the population that the BLS, the Bureau of Labor Statistics, studies are people who are age 16 and up and what they call uninstitutionalized. When they calculate the labor statistics, they exclude people who are in institutions like prison or the military, or people who are in assisted living places like nursing homes for the elderly or homes for people with handicaps. So those people are excluded from their labor statistics. Okay, but otherwise, they describe the labor market behavior of everyone 16 and up. And everyone gets classified into one of three groups: either employed, unemployed, or out of the labor force. And approximately the way that we're supposed to think of these is that the number of people who are employed, those are people who can find satisfactory jobs. Satisfactory. I can't spell today. Oh, you know what? Satisfying jobs. Okay, unemployed, those are people who cannot find suitable jobs. So the reason that we measure how many people are unemployed is because we want to know how many people want to have jobs but can't find them. And out of the labor force kind of means, so I'm doing these approximately equals signs, kind of means voluntarily not working. And this category is for groups like, you all are, like, probably many of you are not working, but it's not because you can't find a job, correct? You're not even intending to work. You're voluntarily not working. As the BLS would describe you, you're out of the labor force. So these are groups like students, retirees, homemakers, stay-at-home parents. Okay, those people are typically out of the labor force. But again, everyone falls into one of these three categories: employed, unemployed, or out of the labor force. And these first two categories together, these are the labor force. Kind of, they measure the number of people who want to have jobs, who are willing and able to work. Okay. Then, on a more technical level, let me explain how they actually go about determining someone's status. It basically boils down to two questions. The BLS asks in the survey, first, are you currently working for pay? I think during the past week, have you worked for pay? And if the answer to this question is yes, well, of course you can say yes or no, but if the answer is yes, then you are employed. Okay, end of story, basically. If you're working for pay, you're counted as employed. Now, if you say you're not working for pay, the next question is whether you are searching for a job. Okay, and again, that's essentially just a yes or no. If yes, you're searching, then you are classified as unemployed. Okay? You don't have a job. Well, you're not working for pay, but you are searching, then you're considered unemployed. If you are not searching for a job, you are classified as out of the labor force. OLF, out of the labor force. Okay, and that's it. So everyone ends up in one of these three categories, and it boils down to these two questions. And I bring this up so you all can understand what the unemployment rate does and doesn't measure. Like, this is literally what it is, and this is how people are classified as being employed, unemployed, or out of the labor force. So basically, to be considered unemployed, you must meet two criteria. Okay? Or to be considered unemployed means you are not working for pay but you are searching. I think the question for searching is, during the last 4 weeks, have you searched for a job? Something like that. But it's based on your responses to these two questions. So that is exactly what it means to be unemployed as far as the official unemployment statistics go. Now, there are a couple of things that get calculated from these responses. One is the labor force participation rate. Participation rate is the percent of the population who are in the labor force. So this is the size of the labor force relative to the population. Okay. I'm going to put right here times 100%, because usually it's written as a percent. Okay, the labor force participation rate, another way to think of this is the numerator is employed plus unemployed. Usually when the labor force participation rate is mentioned, it's not for the overall economy, but rather for special groups within the economy. So like the labor force participation rate for women, or the labor force participation rate for black men, or the labor force participation rate for some group like that. Okay. So labor force participation rate is one thing that comes out of this. The other is the unemployment rate. And the unemployment rate is the fraction of the labor force who are unemployed. Number of people unemployed over the size of the labor force, which is employed plus unemployed. Okay. And again, I'll put times 100% because usually we express it as a percentage. Okay. And so here I've told you how these things are measured, how it's calculated, and that's all there is to it. It's not a terribly complicated or sophisticated calculation. I will note a couple of things. First, like what we have in the numerator is the number of people who are unemployed. Just to be clear, it's not everyone who is jobless. It's not everyone who isn't working. It doesn't include the people who are out of the labor force, in other words. And in the denominator, it's just, this is out of the labor force, the fraction of the labor force who can't find jobs. So it's not the fraction of the population. Okay. Okay. Now, let me talk about some issues with interpretation of the unemployment rate. Kind of the way that we'd like to think of the unemployment rate is that it measures the fraction of people who want but cannot find jobs. So the fraction of people who are willing and able to work but cannot find jobs. Okay, again, that's more or less the interpretation of the unemployment rate. However, it is not so simple as that. There are some other things that can contribute to the measured unemployment rate. The one that labor economists worry about the most are discouraged workers. And this is the fact that when the economy is especially poor, or the job market is especially bad, people can stop searching for jobs. So bad job market, people stop searching, and then they are classified as OLF, out of the labor force, not unemployed. Okay, so imagine that your job was a restaurant cook, and everything was going fine and dandy up through February of 2020, and then a pandemic hit. And by April 2020, all the restaurants in your state had shut down. Well, your state had gone into lockdown. No one was eating in restaurants. Most of the restaurants had to close. A handful of restaurants still did enough carry out and delivery that they stayed open. But, you got laid off from your restaurant, and there are hundreds of cooks fighting for the jobs at the few restaurants that are still open. Like, why even bother applying for a job at this point? You're not going to get it. Restaurants aren't hiring new cooks during the COVID lockdown. So you simply don't apply for jobs. That's the situation of a discouraged worker. Does that make sense, like that example? Now remember that the official definition of unemployed is that a person is not working for pay, but is searching for a job. So those discouraged workers are not classified as unemployed. They're technically out of the labor force. So, again, this is these are really people who want jobs but can't find them. They just don't match the description of unemployed. They don't match the criteria perfectly. And it's a symptom of an especially bad job market, like a job market that is so bad that people give up on searching. That's when people start being classified as out of the labor force, and it makes it look as if the unemployment rate is lower than it really is. The unemployment rate understates the fraction or the number who want but cannot find jobs. Okay, now this actually came up during one of the political debates. I believe it was the vice presidential debate when Vice President Biden and Senator Harris were talking about the economic recovery from the COVID lockdowns. And, of course, many jobs were lost during the weeks and months immediately following the lockdowns in March and April. But as Vice President Pence pointed out, the number who were unemployed had gone down substantially. So maybe there had been 20 million people who were unemployed during the months after COVID, but that number had come down substantially. Like it had gone down by about 10,000 people. And the vice president pointed to this as evidence of people returning to work. Senator Harris pointed out that some of that reduction in unemployment is in fact discouraged workers, comes from discouraged workers, people who are just giving up on job search during the COVID time. And she was in fact right. About half of the decrease in unemployment was from people returning to jobs, and the other half was from people who just stopped searching for jobs. Okay, so what labor economists describe as discouraged workers. So the measured unemployment, again, can understate the number of workers who cannot find suitable employment. Okay, next on my list of concerns, another is potentially added workers. Okay, and this happens when one household member loses a job and other previously out of the labor force members start searching. Joins the search. Okay, imagine this. Imagine that I'm a stay-at-home parent, or I'm a homemaker, and my wife is the one who has a job where she gets paid. Then my wife gets laid off from her job. So she loses her job and she starts searching again. She's unemployed. But since nobody has a job, I start applying for jobs as well. I start looking for jobs too. So at that point, I join the search. I'm applying for jobs, and I get classified as unemployed as well. Now, really, my family might be looking for just one job. Like if I find the job, then I'm the one who works, and she is the homemaker. Or if she finds the job, then I'll go back to being the homemaker. So one person lost a job, and we are really looking for only one job, but two people are counted as unemployed. So again, the measured unemployment number might not accurately represent the number of jobs that we can't find. There are two of us searching for jobs, but really there's just one job that we're looking for. So for this reason, unemployment rate might overstate the number of jobs that people are looking for. Now, third on my list of things to think about when interpreting the unemployment rate is underemployment. People who cannot find suitable jobs but still work for pay. Okay. And as long as a person works for pay, the person is considered employed. The person is not considered unemployed, even if they don't have the hours they want, even if the job isn't satisfactory for them. You know, this morning I opened up my email and I got something that was basically spam, saying that some food delivery company was looking for drivers willing to pay $9 an hour to, deliver food from restaurants to people's houses. And, the thought crossed my mind, like, what would it take for me to accept a job like that? Could things get to the point where the university is laying off professors and I'm like, well, got to do something to pay the bills. And I go out in the evening delivering food for restaurants. I mean, if so, I'm sure, I would not be happy with that job. I would think it's not a suitable job. I'm sure I would not have the hours that I wanted or the pay that I wanted or have a job that's well matched to my skills. It wouldn't be a suitable job, but I'm considered employed as far as the BLS is concerned. I'm not an unemployment statistic. Okay, so, here, because of underemployment, the unemployment rate might understate the number who cannot find suitable employment. Of course, by the way, in the background of my story was the assumption that delivering food was not a suitable job for me. That, I hate to say this, probably I was assuming it was beneath me. Okay, shows where my prejudices are. Okay, anyhow, so these were some things to think about when you listen to official unemployment numbers. And, every month you will, if you listen to the business news, every month unemployment numbers will come out. People will interpret them as a signal of the health of the labor market. You will also hear politicians talk about the unemployment rate or the unemployment rate for different groups. As I said, Vice President Pence was talking about what had happened to unemployment following the COVID lockdowns. Also, President Trump has talked about what has happened to unemployment rates in the U.S. during his presidency. And again, people take it as a sign of the health of the job market. And, it's not necessarily true. This is why I wanted to talk about, let you all understand a little bit better what the unemployment rate is, how it's measured, and also some of the, qualifications to interpreting it simply as a measure of the health of the labor market. Okay? Sound good? Alrighty. Next thing I'm going to talk about relating to unemployment is the different types of unemployment that happen. So, okay, types of unemployment. There may be 3 types of unemployment, and they have different causes, different characteristics, and so labor economists distinguish between them. These are frictional unemployment, structural unemployment, and cyclical unemployment. Okay, frictional unemployment is people who are actually really just between jobs. Okay, this is typically short-term, and it's actually kind of good to have frictional unemployment in the economy, in the job market. Okay, so these are people who were working one job, and then for whatever reason, they left their job, they quit, they were terminated, their job ended, and they're searching for a new job. Again, between jobs, they ended one job, they're looking for a new job. Typically it's short term, and it's good for the labor market. It's a healthy thing because it gives workers an opportunity to get matched with jobs that are more suited to their skills. If, for example, at the end of this semester, my boss comes to me and says, Stephen, I just don't think you're cut out for teaching economics, so we're going to have to let you go. Then I'd be sad, but, the reason he's letting me go is because I'm just, not very personable, or I don't grade things, or whatever. I have some things that make me a bad teacher. Doesn't mean I'm overall a bad worker, maybe. I just need to find a job that's better matched to me. So I spend some time searching for a job, and then I find someone who does want to hire me for who I am and what skills I have. And that's good, right? I've gone from a job where I've gone from a job that wasn't a good match to a job that is a good match. That's the healthy thing about frictional unemployment. Okay, it's part of transitioning workers into jobs that are well suited to them. Okay, structural unemployment is caused by institutions or laws that create, barriers to job formation. Okay, and this is long-term, and I think this is also, bad. Maybe I shouldn't say bad. Let me use the words for frictional unemployment. Let me say it's healthy. Structural unemployment is unhealthy. Okay. So an example of something that might cause structural unemployment is a minimum wage that's set too high. Right now, there are politicians throwing out the idea of a $15 an hour minimum wage across the nation. That sounds fine and dandy until you realize that some people are not going to be able to find jobs. Like some people, especially like the least skilled workers, are not going to be able to find jobs. It's going to create a barrier to employment for people who, bless their hearts, the most they can do is produce $11 worth of widgets in an hour. That's all they can do. Well, if there's a $15, if employers are required to pay at least $15 an hour to all workers, nobody is going to hire that worker who can only make $11 worth of widgets in an hour. So that person is going to be pushed out of work. And as I said, institutions or laws create barriers to job formation. That person is not going to, that person would not have a job for them. A lower minimum wage, yes. But this $15 an hour minimum wage means there are no jobs available for people with low skilled. And it's going to be a long-term thing for this person. Unless a person picks up some new skills, they're not going to have a job. They're going to be long-term out of work. And this is, again, structural unemployment is the name for this. This is the kind of thing that economists don't like. It's unhealthy for the labor market when you have someone who can, in fact, produce some widgets, $11 worth of widgets in an hour, is just not allowed to have a job. Now, other barriers can include, kind of paradoxically, worker protection laws, including laws that make it difficult to fire workers, kind of paradoxically make it harder for workers to find jobs. To some extent, that depends on the laws, which vary a lot from state to state. North Carolina is what we call at-will employment. Which means that an employer can just stop paying a worker at any time without any reason. Okay? I can just decide from 1 minute to the next, I'm not going to pay someone anymore, and just let them go. Okay? Again, at-will employment. There are no restrictions on, I have to give my worker 2 weeks notice, or I have to provide severance pay. I can just end the relationship at any time without any reason. Okay, so that is in some ways good for hiring workers. Because my position as an employer might be that I'm not certain how long I need this worker at my firm. It might be a short-term thing only. Well, if I'm going to get hit with high costs of letting the worker go, I'm not going to hire a worker when my needs might be simply temporary. If there are no costs, I'll hire you. Maybe this will work out, maybe it won't. As long as you're useful, I'll keep you around. At-will employment allows that and allows those jobs to be created, whereas laws that make it difficult to lay off workers will create fewer jobs. Another example of a barrier to jobs or barrier to creating jobs is actually union protections. So this is a really bizarre thing. Okay, there's been talk here at Elon, or there's been an effort at Elon for some of the faculty to join a labor union. And among things that the labor union wants is to make it difficult for the university just to decide, we don't need you anymore, to its professors and let them go from one year to the next. Okay, and as a worker, I understand that protection. It would be a nice thing to know that I've got long-term job security, that my employer can't just send me home and say, we're done with you. On the other hand, what this means, and what in fact happened this past year, was a couple of people who are part of this union, the university did not re-employ from last school year to this school year. As a matter of fact, the budget was a big mess this year. COVID hit universities hard. I suspect you all know this, right? It's really mucked with the budgets of all universities. It started with Elon having to reimburse students for room and board in the spring semester, which was tens of millions of dollars that the university didn't expect to have to return. Like, they were planning to use that money to pay salaries, and then had to return it to students. And so that started the mess. Then the university wasn't sure about enrollment numbers for this academic year. Goodness, I mean, there's a lot that's driven by the budget, and trying to get as many students back on campus, renting out the dormitories to full capacity, having people pay their usual tuition. There's been all this pressure on the university to bring in revenue, okay? And, I mean, finances are an issue. I mean, I'm not, like, for any organization, finances are an issue. I'm not going to say that Elon is any worse than others. Anyhow, the budget has been difficult, and to be honest, there are a fair number of faculty who were teaching here last year who were not re-employed for this school year. And, the explanation for many of them is, budget issues. And I do believe that's a reasonable explanation. However, a couple of the union organizers felt that it was potentially unfair, and so contested this, which drags the university into a long legal dispute. Okay, that's not what the university wants. If the university knows it's going to get into legal disputes and have a union breathing down its back whenever it, let's say, unhires a person, it's going to think twice before it hires a person. Does that make sense? Okay, so that worker protection can be a barrier to job creation. That's one of the paradoxes of unions. Again, that kind of worker protection works can kind of backfire and result in fewer jobs being created. Again, that's what labor economists describe as structural unemployment. Institutions, a labor union in this case, that prevent jobs from being created. Now, the third type of unemployment is cyclical unemployment. This is due to like economic fluctuations. The economy is bad and demand for some industry goes down. The industry has to lay off workers. Once the economy picks up again, the industry will employ workers again. Now, that's the only comforting thing I can say to my colleagues who were not reemployed for this school year, is that at least I would expect that once COVID has sort of settled and like we figured out how to control it on campus, most of us are vaccinated. When there is an outbreak, we know how to control it. Like once things get settled again, their jobs will be back. The university will still need to hire just as many people to teach just as many students, and their jobs will be back. Cyclical cyclical unemployment, that's just because of fluctuations in demand and supply. Okay, and I'll just say this is just sort of natural changes in market equilibrium. I'm not going to rate it as healthy or unhealthy, but it's just a natural consequence of demand and supply for workers fluctuates. Okay. Any questions on this or any comments? You guys are so nice and quiet. I kind of don't mind that, but because I can keep talking about things that I find interesting, but I also don't want to bore you all to death. Okay. If you all are good with unemployment, I'm going to move to the next topic, which is financial markets. Yeah?
With the workers' unions like you were talking about, how come that's not like more common knowledge? Why do people want to keep starting labor unions if it's going to make their jobs not? You know what I mean? Like it's going to be harder for them to stay employed or get employed.
So your question was, why do people start unions if they know that union demands are going to backfire? And that's something that I, as a labor economist, wonder about. It's a difficult thing. And I will note, by the way, this is recording. I'm not sure if I should record this, but okay, fine. I will note that the people organizing the union were not faculty members from economics or business. I don't know of anyone who had taken a course in labor economics. So I think some of it is that they don't understand the complexity of the situation. Another part is, in fact, unions are good for the people who can get in, but like if you can get hired under union conditions, it can be good, but the problem is some people don't get employed because of those conditions. A bigger concern are the long-term consequences of unions because they drive up costs for manufacturers. I'm thinking right now especially about unionized labor in manufacturing. So like steel or production or automobile production. The problem is they drive up costs, and the market if the market is competitive, then that means their employers cannot survive paying a higher cost for labor. And so employers have responded in one of a couple ways. I mean, in some cases, the high costs of union labor have just caused companies to go out of business because the competitor hires workers at the market equilibrium wage. The company with unionized labor pays a higher wage for the same labor. The competitor can produce the same good at lower cost and is going to drive the company with unionized labor out of business in the long run. Or employers change their behavior to avoid paying the higher labor by, for example, shifting production to a different location. And automobile manufacturing that used to be done, especially in the state of Michigan, a lot of that has shifted to the South, like the southeast part of the U.S., or shifted overseas. That unionization, those higher union wages, caused jobs to go away. There were nice higher wages for a short period of time, but then it backfired in the long run. So
I've seen even like more extreme cases where unions, like the employers, they were trying to get rid of pensions for their employees because it was going to make them go out of business, and switch it to 401ks in the future, like on a new union contract. And the union and the employees knowing this, that if they forced the employer to not be able to switch over to 401ks, that they would all lose their jobs and the company would go out of business. But they still fought to keep the pensions.
Yeah, so what you're saying is something about, by the way, I'm repeating this for the people who can't hear. At one company, the employer wanted to switch from offering what's called a defined benefit pension, a traditional pension that promises a fixed income over retirement, to what's called a defined contribution, where people contribute to a 401k savings account, and then once they retire, they've got whatever's in the savings account, which is a pretty common transition. And the workers at the firm were fighting this change, even though they knew that sticking with the existing pension plan would result in the business going bankrupt and being unable to pay the promised pensions. Yeah. I don't know how to respond to that other than, yeah. This kind of thing happens, and sometimes it's, people don't necessarily trust the employer. They don't understand the economics.
I think it's really fun. The same stuff happens with the states with like teachers unions. Like in the same scenario, they want to get rid of the pensions because the pensions are going to make the state go bankrupt. It's just going to raise taxes and then reduce the wages of teachers.
Yeah.
Like, unions don't make any sense.
Unions don't make any sense to you, and you're bringing up something about teachers' unions. Do you know? I mean, you're not from the South, are you?
I'm from New Jersey.
Yeah. Okay, you're from New Jersey. Okay. In North Carolina and in many states in the South, state employees basically cannot unionize, or the state government will not negotiate with unions or other terrorists.
It's the opposite in New Jersey. They have to be.
So, teachers' unions don't exist. Okay, but yeah, unions are complicated. They are an entire topic on their own, and I think sometimes they're good intention. They have good intentions, but economics is complicated. Okay. So now I'm going to move on to a completely new topic, which is financial markets. And financial markets, this is all about transactions between lenders and borrowers. Okay, transactions between lenders and borrowers, kind of exchanging money over time. Is how I think of it, exchanging money over time. I mean, basically, we could have an agreement, or there could be an agreement between, Stephen, I'll pick on you. You could you could trade me $100 today for $105 in a year. Okay, it's like you give me $100 today and I give you $105 in a year, and we decide that's the trade we're going to do. Okay, that trade is possible, right? But what we've done in common language, or the way people would think of it, is he has loaned me money, I've borrowed money, and I'm repaying it with interest. Okay, we're just trading money across time. Again, it's all about transactions between lenders and borrowers. And so this is going to get a little bit complicated, because things that we think about, like saving, when you go down to the bank and you deposit some money into a savings account, you're not really saving it. You are loaning it to someone, okay? You're being a lender, because the bank doesn't just put it in a safe spot for you and keep it there. The bank takes the money and gives it to someone else in order to get some interest off of it. So you are just asking the bank, you're not really asking the bank just to store your money safely, you're instead asking the bank to loan the money out to someone else. So again, savings is really a matter of loaning, what we typically call saving money. It's a matter of loaning money. Sometimes we talk about people as investors, we buy and sell and trade stocks in the stock market. We are investors. No, we're not. We are loaning money to corporations, or we are purchasing financial instruments that are effectively loaning money to others. So again, things like investing in stocks, etc. These are really loaning money. Okay, and really there are a handful of groups that loan money, but especially households, some businesses, firms loan money. So these are the lenders. And then the borrowers include the same groups, households, businesses, and households, businesses. And the one group that is a borrower and rarely a lender is the government. Loves to borrow money from people. Okay, now the lending and borrowing doesn't usually happen directly. Like if you have some money and you want it to grow over time, well, the way you do that is by loaning it to someone, but you don't go out and find the person to loan to directly. You don't go around saying, hey, I've got $1,000. Who wants to borrow my $1,000? Who wants to borrow my $1,000? Instead, you take it to the bank, you put it into your bank account, and the bank does the loaning for you. So there are some financial intermediaries which help make the market clear. And these include banks and mutual funds. Okay, so again, you don't handle loaning out the money on your own. Instead, you hand it over to a bank and ask the bank to find a good person to loan it to. And then the bank, provides it to someone as a car loan or a mortgage. But the bank does the work of finding the borrower and then screening the borrower to ensure that the borrower is going to repay, the borrower has the ability to repay, and so forth. So the bank does that job in between, helping the market clear. Okay, it's what we call a financial intermediary. Another type of financial intermediary is a mutual fund. Who has an idea what a mutual fund is? Okay, one person, yes, two, 1.5. Who has no idea? Okay, couple of people. Do you want to explain what a mutual fund is?
Are you talking about like ones that you can invest in?
The ones that you can invest in,
Like that?
yes. The ones that you can loan money to would be the correct
Yeah,
statement. But yes, it's common people say that you invest in.
like it's just a collection of different companies on the market that you can invest or loan to all of them at once.
Yeah, so a mutual fund it kind of uses money from a group of lenders. Okay, who would like to think of themselves as investors? Okay, now this is one thing that I'll emphasize. It's a group of lenders. And then they purchase stocks, bonds, assets from a variety of sources. So instead of you going out and deciding you are going to buy a stock in one company, or you deciding that you're going to buy stock in 2 or 3 different companies, you give your money to a mutual fund, and then the mutual fund does the research of identifying the 20 best companies to buy stocks in, and it purchases stocks in all of those companies on a large scale for a large group of people. From your perspective, like as a lender, you just, like, people think of it as they buy a share in the mutual fund, and it looks like the mutual fund has invested in a bunch of different companies, usually purchasing stock in a bunch of companies or purchasing bonds from a bunch of companies. And I'll explain stocks and bonds in a minute. But it looks like they are essentially picking out a bundle or a basket of stocks for you. It's kind of how it happens. That's a fairly accurate but greatly simplified version of what the mutual fund does. But it serves as a financial intermediary so that you, as one investor, don't have to directly pick out the stocks that you want to purchase. Instead, you let the mutual fund manager do that for you. And the mutual fund manager isn't doing it just for you. Mutual fund manager is doing it for a large group of people. So a mutual fund might have billions of dollars in assets, or like take up billions of dollars from lenders and use it to buy billions of dollars worth of stocks. And there are thousands of mutual funds like this. And they are provided through investment banks like Fidelity, Janus, JP Morgan. There are lots and lots of banks that have mutual funds. This is how, I think now this is how much of, or like many people store much of their savings, especially retirement savings. Now again, savings is a tricky word, but what people think of as saving for retirement is instead loaning money to a mutual fund. Or what they think of as investing in the stock market is often loaning money to a mutual fund or purchasing shares in a mutual fund. Again, this is how much of your savings will be handled over your lifetimes, and this is how much of your retirement will be handled. Your parents do this with their retirement. Okay, so again, a mutual fund, it's like some company has picked out the best stocks, and you give them your money, they buy those really great stocks on your behalf, and on the behalf of a whole bunch of other people. Different mutual funds like pick out different stocks. They have people who try to look around for what they think are the best deals, or they try to emphasize going into one industry or another, or they have different strategies. I would love to spend days and days rambling on and on about this, but they have different objectives in what they do. Okay, so as I said, financial markets are about borrowers and savers coming together, borrowers and lenders coming together, sometimes through an intermediary like a bank or a mutual fund. Now, the two, let's see, so there are maybe three important types of, let me do something different. Okay. Let me do especially corporate finance. Okay. Corporate finance, so this is how businesses borrow money or how they acquire money in order to fund whatever it is they need to fund. Imagine that I want to start a business. Well, one of the things I need to do is get money to buy the equipment, rent the store, buy supplies. I need money to start my business. And I've got really a couple of options for how to raise that money. One is by issuing bonds, and the other is with stock. Okay, or shares. What a bond is kind of like an IOU. That's the way to think of it. But really, it is a promise to make some set payments over a period of time. Okay, a stock or a share is technically ownership of the company, but what people really think about is that it entitles the shareholder to a fraction of profits. Okay. Again, technically, the people who own stocks or the people who have stocks in a company are the owners of the company. And I talked about this maybe a month or two ago, what a corporation is. A corporation is a complex ownership arrangement. Like a business that is owned with a number of owners who want a way that they can easily sell their ownership shares. Like a very basic business would be a sole proprietorship. One person owns it, they get all the profit from it. The next step in sophistication would be a partnership, joint partnership, where two people own the business together, each gets half of the profits. Okay, or it could be more than two people. But a complication is that they have to make decisions together. And also, if one of those partners wants to leave, they have to find someone to buy their share of the business. Okay, now a corporation is just taking this kind of to the next level, making it very easy to buy and sell ownership shares, to have a market where these are sold. That's called a stock market. And the company is split up into many, many, many small ownership shares that, again, people can sell and buy very easily. Okay, so going back to this, bonds are a promise to make a set of payments, and a share is really a fraction of the profits. So let me talk about where the values of these things come from, or the prices of bonds and stocks come from. Prices of bonds are determined by market interest rates, and risk. Okay, risk is uncertainty. About the future money. Okay, now value of stocks also depends on the market interest rate. And risk. And a third thing the profitability of the firm. Okay, because again, the stock entitles the owner of that stock to a fraction of the firm's profits. More profitable the firm is, the more that ownership share is worth. Okay, now let me go back to this bond, okay, and talk about thinking about what goes into bond pricing. Let me start with a very simple example. Okay, I offer to pay you $50 per year for the next 20 years. Okay, and let's just have no interest payments from banks. No risk. Okay, so forget about the banks offering you interest as like an alternative to loaning me money. Or well, maybe let's not even talk about in terms of loaning me money, because literally what a bond is, well, sorry, let me say, back in the olden days, a bond was a piece of paper that would have like little parts that you could detach from it and take to the corporation to get reimbursed for your cash each year. So imagine that I just give you a set of 20 coupons, and you can use one per year to like claim $50 from me. So this example that I've given you, what's the most you would be willing to pay for that? Like, it promises you $50 a year for the next 20 years. Does it seem reasonable that the most you would pay is $1,000? Right? Would be kind of a fair price for that. Yeah? Okay, so that's just starting to think about like what goes into determining the price of a bond, and the way that we think about going from the promised payments to what it is worth, how much someone would be willing to pay for it. Now, I'm going to give a slightly different example. Okay. You've got two choices with your money. Either put it into the bank, which offers 5% interest, or buy my bond and this bond that I'm selling right now will give you $100 per year forever. Okay. The name for this type of bond, I believe this is called perpetuity. Okay. It's not common, but this could be done. I promise that my company promises that it'll pay you $100 per year forever. So you've got these two choices, what you do with your money. You can either take it to the bank. The bank will pay you 5% interest. Like every year, it'll give you back 5% of however much you save. you've also got the option to buy my bond, which again, each bond you buy from me is a promise to pay you $100 a year forever. So, how much would you be willing to pay? Well, you have to think about what amount of money you could save in the bank that would also give you $100 per year. And if you would put, let's do $2,000 into the bank, 5% of $2,000 is $100 per year, right? So you would be willing to pay up to $2,000 for my bond that I'm selling. Okay, again, so what I'm doing is I'm selling this promise that's going to give you a certain stream of payments. And you kind of translate that back into what it's worth right now. Okay, now a couple of things will impact this. I mean, one thing I'll point out is that the interest rate in the market will definitely change the value of this bond and what people are willing to pay for it. So if the interest rate at the bank were to change, if the interest rate went to 10%, okay, again, that's what banks are offering, then actually the most you would be willing to pay for my bond most willing to pay for the bond would be $1,000. Because you've got the option of paying $1,000 for my bond that promises $100 a year, or you could take your $1,000 to the bank and get interest payments of $100 per year from now till forever. So, and like, that's a toss-up for you. So again, the most you'd be willing to pay for the bond, $1,000. So it's kind of interesting, actually, when the interest rate at the bank goes up, the value of the bonds goes down. Okay? But the most important thing I want for you all to pay attention to or to be aware of is how the value of the bonds or the price of the bonds is determined by, in this case, the stream of payments that's been promised, as well as the interest rate will impact what people are willing to pay today for that bond. Now, there's another important thing that I haven't mentioned yet. That's risk. Okay, risk means uncertainty about what you're actually going to get out of this, because things can go wrong. Like, think of this promise that I'm going to pay you $100 per year from now till forever. You really think I'm going to be able to follow up with that? Really? Till forever? I mean, in a few billion years, the sun's going to blow up the earth and all of that. So we know that I'm not going to be paying you at that point. We're all going, like, everything's going to be gone. But businesses never last more than a couple hundred years, really. I mean, most businesses are lucky to survive a few decades. You know, one of the risks that the bondholder takes on is the risk that the company goes out of business And another is that the company doesn't have money to repay. So risk, the firm shuts down. Okay, and even if the duration of the bond is shorter than perpetuity, even if it's a 20-year bond, there's a chance that the company could shut down in the next 20 years, and then I don't get my money. Okay, the other risk is that the firm has no money to pay. A firm, just like everyone else, has a limit to how much cash they have on hand. They've got a bank account, and when their bank account gets to zero, they can't pay their bondholders. And that's what's called bankruptcy. The business simply runs out of cash and it can't pay people. And those are risks that bondholders take on. Now, bondholders try to do research and, for the most part, buy low-risk bonds. Governments also sell bonds, and this is an important way that governments finance things, by selling bonds. Probably the most secure bonds that a person can purchase are ones from the United States government, because the U.S. government will probably not shut down anytime soon, and it will probably always have money to pay, especially since it can always print its own money to pay off its own debts. So those are the lowest risk bonds, but there's always risk for companies that one of these things will happen. Now, risk means that that the lenders, people purchasing the bonds, will not pay the full expected value. Okay, you can't expect that someone will purchase a bond for exactly what they would expect to get from the bank. If the bank is secure, I'm just going to assume that, okay? But for the most part, it is true that bank accounts in the U.S. are secure. That money is not going anywhere. If the bank goes out of business, the federal government promises to pay people for the money they had in the bank. Banking deposits are insured by the federal government. Okay, so your money in the bank is safe. You would never be willing to pay as much for a bond that is risky. So there are two ways of thinking of this. One is that the lenders don't pay the full expected value. The other way of thinking of it is when they purchase the bond at a discount, they get paid a premium for the risk that they agree to. Okay? So again, they get paid a premium for the risk. The riskier something is, the more that it has to promise as an expected return. Okay, so riskier bonds will generally pay off a higher average amount, expected amount. Now, moving on to the other topic here, or the other type of financial instrument, stocks. Okay, again, a stock is like an ownership share. But for practical purposes, what's important is that it entitles the owner to a percent of the company's profits. So imagine that I've come up with this great idea for a business, and my business, for this example, my business is expected to generate, how much should it be? $5,000 of profit per year. Okay, and then I offer for sale a 1% ownership share. Okay, so I've got this really great idea to start up a new bakery. I just need to get some cash in order to finance it. And if I can get this together, it'll produce $5,000 of profit per year. Now, what I'm offering you is 1% of those profits. Okay, so in other words, this is expected to generate $50 per year. Okay, and basically for as long as the firm exists. Okay, it's kind of like one of those perpetuity bonds in that sense, that it is an expected amount of money for as long as the firm exists. And so the pricing would be more or less the same. This is like a firm, this is like, well, as far as money goes, this is equivalent to promising someone $50 per year. And the price would be determined similarly. So the price is based on the market interest rate. Hey guys, would you all mind if we go maybe about 5 minutes overtime tonight? Would you hate me forever? Okay. So I can wrap this up. Okay, price is based on the market interest rate. So if banks are offering a 10% interest rate, that means that $500 deposited in the bank would generate $50 per year, right? So if my firm is offering to sell something generating $50 per year of profit, the most someone would pay for it is $500. So therefore, like logically, the price of the stock should be $500, right? Price of a stock that is expected to generate $50 per year. Okay, should be $500. Now again, this actually this value, this price for the stock, depends on the market interest rate. If the interest rate were 5%, sorry, I underlined the wrong thing. This price, $500, that would be higher if the market interest rate were lower. People would be willing to pay more for an ownership share that generates $50 per year. However, as I mentioned before, there are some risks. Okay, and people would not pay the full $500 for the stock. They would actually be willing to pay less because the bank, that's a guaranteed $50 per year. My business, I'm suggesting it's, we expect it's going to generate $50 per year, but it could change. Because if like something happens in the market and, it turns out that my company doesn't actually produce the $5,000 of profit that I expected, it only produces $4,000 of profit, then your share, like your money that you get as a shareholder goes down if the business is less profitable than expected. Flip side of that, if it's more profitable than expected, you get more money, but you're making guesses about how profitable this business will be in the future. Some markets are fairly low risk. Some businesses are low risk. We know what to anticipate. Other industries and other businesses are riskier. It's harder to predict what profits will be in the future. But those future profits do impact the value of the stock. So going back to that, if this $500 profit per year changes, it's going to change the value of the stock. And that's a lot of the movement we see in the stock market comes from changes in expectations about how profitable businesses will be. That's also why we hear so much news about the stock market from day to day. When we hear information about the Dow Jones Industrial Average, that's the average price of a bunch of stocks from important companies. Or we hear about the NASDAQ price index. Again, that's the average price of a whole bunch of stocks. The reason that those go up and down from one day to another is mainly because of changes in expectations of how profitable the businesses will be. Okay? There was a day back in early March when news of the pandemic caused the stock market to drop by 5%. And, this was early in the year. I was just shocked. I was talking to my wife. I was like, do you realize that means that investors believe that companies will become 5% less profitable? One way to interpret that is 1 in every 20 businesses might just disappear in the next year. Just that 5% drop was huge. And I was like, this is big. People think this is going to be a really big deal, and markets don't lie. So again, the reason the stock market changes from day to day is, the stock price for any company changes from day to day is because of changing expectations about how profitable that business will be. And this is why people are interested in the stock market, because it gives us a general picture of our expectations about the future. The fact that the stock market has been increasing recently indicates that investors generally believe that companies are going to become more profitable. They're going to be generating more profit. Therefore, the prices of the stocks go up accordingly. But now, that's a source of risk as well. The fact that the fact that the profits are unknown is a source of risk. So as I said, risks for stocks include the risk that the firm shuts down. Also, another risk for the shareholder is that the firm has no profits. And kind of third is uncertainty about the profits. Okay, let me say, firm has no profits. Let me change this second one. Has no cash to pay anyone. Okay, I mean, it goes bankrupt. Now, if we just compare a bond to a stock in terms of riskiness, stock in a company will always be more risky. Because, I mean, someone who owns a bond, they lose money if the firm shuts down, and that's the same for someone who owns a share. Those two things are the same. If the firm goes bankrupt, both bondholders and shareholders lose money. However, I'll note that bondholders get a claim to the firm's money first, because the bond is a promise to pay money as long as the firm has money. And then the shareholders get basically what's left over after that. So if there's limited money, it goes first to the bondholders. Okay, so if the firm is bankrupt, for certain, the shareholders don't get money, don't get profit on their stocks. Now, the third thing is the extra risk of owning a stock is the uncertainty about the profits. The bond, it's a fixed promise payment. The share, it's a fraction of profits, and that could vary substantially. No one would have thought a year ago that some pharmaceutical companies would become very profitable during the upcoming year, or companies that manufacture protective equipment would become very profitable in 2020. No one really anticipated that. No one anticipated the negative impact of the pandemic on travel. Okay, so there's always uncertainty about the profits, and that's the big extra risk of owning stocks. So, in terms of risk, let me kind of wrap this up. In terms of risk, stocks are riskier than bonds, and bonds are riskier than banks. Okay. But also, a consequence of that. Remember I said that investors need to be paid a premium for taking on risk, so they get a higher expected return, a higher average return when they invest in something risky. So the expected return on stocks is always higher than for bonds, and that's always higher than the return from banks. Okay, so this is kind of an important thing. Oh, I'm so far past time. This is an important thing, however, for understanding your own savings or making smart savings and investing decisions, is that the higher the risk, the higher the expected return. And it always goes in this order. Stocks riskier than bonds, riskier than putting your money in the bank. Okay. Are we done for tonight? Okay.